Let me cover why that's important. Let me cover why the management is important, even with these high return spreads. I actually want to go to radioactivetrading.com right now. And what I want to do here at radioactivetrading.com, this is where we focus on the married put approach, controlling risk with the married put preferred structure, but using the 12 different income methods against it. But one of the unique tools here, in addition to all that great information on protection and long-term growth, in the resources tab at Radioactive Trading, we have the trade simulator tool. And what the trade simulator tool does is it allows us to put in an expected target for our strategy of return we would look for, the loss limit we're willing to take either through stops or through management, probability of loss, reverse of the probability we're talking about, probability of success, starting amount, and invested per trade. Now I have some defaults that I put in for the credit spreads, but I'm going to show mine first. I actually used this tool back in mid-2016 to say, hey, if my targets for credit spreads long-term were to achieve this type of goal with a certain success rate and less management, what would I set? Okay, so let me look at a 25% targeted return with a loss limit. I don't know, I'm only going to risk 50%, meaning that if I have a 5-point spread and I collect the 25% net credit against the position, that if the stock falls to where my liquidation debit is around 250, I'm going to close it out right away. I can't afford to take more than a 50% loss. But here with a 25% target, I'm looking at a 75% probability of success. And that's how it usually works out. So this would be a 25% probability of loss. I'm going to start out with $10,000. And I'm going to allocate, which would only, by the way, that $10,000 I'm allocating here would only represent 10 to 15, maybe 20% of my total portfolio. We fully advocate that we're using spread positions where you can lose 100% of what you invested in the debit spread or 100% of the margin requirement for the credit spread. It should only represent about 10, 15, or 20% of your total portfolio. So if an unexpected market event happens, and all three of your positions are wiped out to 100% loss, that only brings your portfolio down 10 or 15%. But closing it at a 50% maximum loss, that means when I have 3 or 4 positions open that represent 15% of my portfolio, even in a market crash, when I have 4 bull put credit spreads open, the maximum loss to my total portfolio would only be 7.5%. I can stomach that and continue to move on. But yeah, I'm going to open 3 trades here, so we're going to allocate 33%. Now, what this tool does is it goes out and flips a coin 100 times. Heads, I win, and I make my 25% in this case. My apologies, Alfonso. Tails, I lose, and I lose the 50% of the $3,300 I would have invested with 1/3 of the trade. And it just keeps going and cycling. So over the course of 100 trades, if I only hit the mark of 70% success rate in this case, not 75 where I wanted to be, but at one time I almost doubled my money and I think I have a positive trading account. But towards the end, after 100 trades, I'm only up for 15%. Okay, that's not bad. That's not bad at all. We got to get to 75. There's 7. So every time I refresh it, it's running it again. There's 72. Hey, all right. Now we're up to almost double again. 79. Wow. Doing phenomenal. I mean, almost a factor of 10. We've increased our profitability by our portfolio count by a factor of 10. But I want to get, it's random every time. I'll use this one. 25% return with a 75% probability. Around the expectations, we saw some of that on those searches that we just ran for Alfonso. At one point, we almost get this up to a 7-to-1. We increased our fold by 7%, but we also saw 25% loss in our portfolio at one point during the position. But we end up here with a success rate of 76 wins, 24 losses. We took $10,000 up to a potential ending amount of $54,575. My apologies. Okay, fantastic. So we run these different trades, we run these different simulations. Now, just as an offshoot, we're talking about a 5-point spread. I'm going to cut my loss to 250. But here I'm not as deep out of the money in the bull put credit spread, right? Because I'm looking only for a 50% probability, 75% probability. My apologies. I'm closer to the strike price. So in a wild swing in the market, I might actually take more than a 50% loss. Same numbers. We're going to try to target this 76% win ratio. What if I allow the losses to, say, go up to 65%? What happens? 81. Okay, we're still very, very profitable. My apologies. I want 81 again, 72. Wow. Lost 70%. 65% of your portfolio value. I want to get to 76 for the fair comparison. 74 is close, but you're down 34%. It's random each time, I know. Just bear with me 1 second, folks. 74, 81. Let's just put this at 23. Let's see if that forces it better to a 76, 78, 75. Okay, so just one trade out of 100 less with allowing the risk to go to 65, still making 25%. Instead of seeing the portfolio potentially have gained fivefold up to 54,000, you're at a loss of 8% at 91.36. That's the importance that I found of keeping the risk to 50%. Now, we showed that example of 25% return, 25% probability, keeping the risk to 50%, whether you consider this as a bull call debit spread or a bull put credit spread. And, we got that 76, 77, here we are, tenfold. But our numbers were 76% win ratio, taking 10,000 up to 54,000. Same numbers, but I'm going to lower the return to 15%. We're going to drop the probability of loss to 15%. Now, 89 wins, 11 losses, 90% win rate. Yeah, you're going to be doing phenomenal. 81, 87. Want to try to, and let me drop this down to 25. So, okay. Let me drop this down to 25 first. Oh, bankrupt. Okay, 78. No, there we go. So in my example, remember, I'm sorry, I did that a little bit backwards. I apologize. In my example that we first ran for Alfonso, looking for the 25% return with a 25 to 75% probability in that case, with the 50% loss limit, 76 to 24, he was up to $57,400. If I looked for positions, bull put credit spreads that I prefer with the 15% probability I want, or 15% return I want, with a 75% probability, I'm at a loss of 50%. That's what I wanted to illustrate. And this is why I decided that going potentially for these higher returns with the lower probability wasn't what I wanted to do. I wanted to look for a lower return, but have that higher probability, the 85% probability or above. And that's what I started searching for first. I apologize. So now let's change that. 76% win ratio isn't going to do it in my structure. It would work for Alfonso's structure if he met those metrics. Now, 85% probability above, only a 15% probability of loss. Almost similar. Took the account up to 58,000 at one point, 9,905 loss on the maximum of 1% drawdown in the position, ending at 40,626. Very similar to what we saw with Alfonso's, assuming he could still get the 50% loss limit. On average, we're at about an 87% success rate with this structure. Over the years, some years it's been 83, 12-month period, some it's been 87, some it's been 90 with the criteria that we use. Again, following still the market sentiment tool, only opening positions at the right time if the market sentiment agrees with it. But here we see taking $10,000, getting near our 87%, 86% projected success rate. We do see a drawdown in the case of some random losers in a row, down to 61.90. That's about a 30%, and I've had that happen in this portfolio before. Again, that's why it only represents 10 to 15% of my total portfolio. But ending amount of $64,180, 10,000 more than what we saw with the potential of a 25% return, 25% probability of loss, or 75% probability, same allocation, same starting basis, and same loss limit on the spreads. So when I started seeing that I was getting that 85, 86, 87% success rate consistently, that's why I use that path. But as we've shown, you can be profitable in other ways with the debit spreads. But even in my structure, especially in my structure, if I allow the risks to go up to 65% of the maximum loss on the position, okay, that's a 91% success rate. That doesn't count. At 76% win ratio, just a few ticks less, I'm almost bankrupt. From $10,000 down to $1,200. 83%, I'm losing money. I'm down 1%, 9% on my portfolio, even with an 83% success rate. So that's why people say, as Alfonso looked at, as we discussed in the discussion for Alfonso, is that why would I take a 10-to-1 to 8-to-1 risk-reward ratio on credit spreads? You don't have any chance of making a profit long term. One trade wipes out 10. And you're right. If you allow the loss to go to 100%, which you won't do as an active trader, to trade credit spreads, to trade debit spreads, even with a high probability, even with that higher return, lower probability Alfonso is looking for, you have to control the losses and be actively managing the positions so you don't take more than a 50% loss of the maximum, and then you'll start hitting your targets on a more consistent basis with the probability you're expecting in either Alfonso's structure or in my structure, and we just illustrated that perfectly. That if you allow the loss to go too far, and then of course, well, there's this balance. Someone's going to ask, well, why would you even allow it to go to a 50% loss? Why wouldn't you cut your loss for the margin requirement on a credit spread or the margin requirement on a debit spread to only be 25, 30, 35% of the maximum loss? Because then you're closing out positions too frequently. You're hitting that loss limit too often, and you're not seeing an 85% success rate in my structure. You're seeing a 65. In Alfonso's structure, you wouldn't be seeing a 70, 72, 73% success rate with that tight of a stop on the maximum loss. You're at a 45, 47, 52% success rate, and you're not achieving your goals. Encouraging controlling risk is something we always do. In the back of your mind, you say, why wouldn't I control risk more to not allow any spread to lose more than a third, 35%, 40% of the maximum risk I could lose? And it's because of the structure of the trade. You're going to be closing too many spreads too often, and you're not hitting your probability targets. And you likely won't be successful. That's why I advocate for the 50% stop. Not losing more than that, even with the high probability trades we see, we hit our goals when we have the success rate that we want. And we show that even with Alfonso's targets of maybe, 25% with a 75% probability, of course, with the same allocation. Now, there are times when if you just have too many losses in a row, you're going to be bankrupt. That happens with the credit spreads too, and the 85% probability. Oh, I'm sorry. Thank you, Alfonso. I did that wrong. 25% probability of loss. There we go. So let's get to that 70. Yeah, there we go. The 72% success rate might see a drawdown of 16%, of course, but almost doubling your money in this scenario. And that works. But again, 72 win ratio. Let's take our loss just a little bit up to 65. With 73% wins, one more win than what we had. You're now at a loss of 50% instead of nearly doubling your money. That is the case. There's no fire and forget position, even with a higher probability of 85, 90% on a credit spread or in the money debit spread. You have to manage it, and this perfectly illustrates why. It drastically changes it. If you allow losses by more than 50% of the maximum risk on the position, you're not going to see the success rate you expected and potential to see 50% drawdowns with leveraged positions that can lose 100% of the margin requirement or the debit you paid in the position. And again, that is why the credit spread or debit spread portion of my portfolio only represents 10 to 15% of the total portfolio. So even if I hit that spot where all 3 or 4 positions lose 50% in a black swan event or unexpected market event, my portfolio is only down 5 or 7.5%. I can take that. I can take what's remaining of that and still be profitable long term after waiting it out a little bit. In a black swan event, bull put credit spreads take a 50% drop, close out all 3 of them, wait until I see the market sentiment tool and power options turn into a light buy or to a strong buy mode, then jump back into the bull put credit spreads. We're still at the sell warning here of the 13 broad-based indicators. So still kind of concerned, but I've got my bull puts 2 expiring today, 2 open for next week. We'll see how they go. If I see this go to a bearish sell warning, a deeper red with more bearish sentiment than neutral, then I might close those bull put credit spreads out early if they're at a profit.